Hello and welcome to Star USA Training. Today is Tuesday, October 25th, and we're going to be talking about the 2020 Incoterms rules. We are recording this webinar. The slides and the recording and any other materials will be made available after the broadcast. All participants are currently muted. Please use the Q&A feature to ask any questions. We'll make sure that there is time for that at the end. For individuals using the closed captions, if there is any difficulty with the initialisms or acronyms or just translations in general, please feel free to reach out to us. We would be happy to help explain the words that we're using or the concepts behind them. I do tend to speak fast, and the closed captioning software does not always keep up with it. There is one CCS credit available. Please send an email to train@starusa.org after the webinar with your NCBFAA ID number, and we're going to get started. So we'll be taking a look at the foundations and the underpinnings that drive Incoterms and why they exist in the first place, where they come from, what they're used for, and what they're not used for. And then we're going to look at contrasting the buying and selling perspectives for each of the major Incoterms. And then lastly, we'll close with some tips and traps, as well as some questions and answers. Some quick background. My name is Mike Easton. I am the President and General Manager of Star USA. We are a trade compliance consulting, advice, training, and services company. We believe that knowledge is power, and using trade compliance regulatory understanding and applying it to your business is your best asset in a global marketplace that exists today. We do provide in and outsourced trade operations, import and export policies and procedure writing, and audit and discovery. We talk to or train on or perform all of these bullet items here: HS, origin value, CTPAT, FTAs, and more. And we also work with your brokers and forwarders to ensure that they're following your internal policies and filing your entries and export filings correctly. And of course, we provide training in all areas of trade compliance. So Incoterms foundations. Again, looking at the history and background, updates that came out in 2020, as well as the importance and application of the Incoterms. The Incoterms are put out by the International Chamber of Commerce, the ICC. It's headquartered in Paris, France. Their website is iccwbo.org. And the Incoterms were born out of a 1920 study, so this is 100 years ago, where they studied that, yes, countries have different trading practices, and they understand terms and terminology differently across regions, not necessarily across country borders, but even within the same country. And that led to an increased risk of miscommunication and misunderstanding, and eventually disputes and litigation, which is very, very costly. So they set out to create a uniformity of interpretation for international trading. And the first set of rules was published in 1936, Incoterms 1936. Incoterms, the word, is an amalgamation of international commercial terms. I guess that's a portmanteau. INCO terms, international commercial terms. So that's where they come from. The current set of rules that we're on is Incoterms 2020. And this provides for 11 different Incoterms rules, 7 that are used for any mode of transportation and 4 that are used for waterway-only transportation. The Incoterms are updated every 10 years. So if you've paid attention since 2020, these should be the same terms that have been in place since then. Only a slight change from the Incoterms 2010 updates, which in turn were a bit of a shift from the Incoterms 2000 updates. The updates are typically based on current industry practices, any changes in documentation requirements, or evolutions in transportation or just global trade in general, and they're incorporated into the Incoterms wherever appropriate to do so. You can buy the Incoterms books directly from the ICC via this web link here, and they do have a digital library available with subscription-based access to a lot of these things as well. When you do buy the Incoterms books, they will ship it to you DDP, for those of you that know what that means already, and that's very handy. Okay, so the 2020 updates. One of the major updates that they did was streamlining the guidance notes. And the guidance notes are extremely useful for interpreting and applying the different responsibilities to each of the parties. In fact, they renamed them from guidance notes to explanatory notes. This is not to be confused with the explanatory notes used by the harmonized system put out by the World Customs Organization. Incoterms have their own explanatory notes. And it arranged the match columns by order of importance, as well as providing more consistent presentation and framing across all the rules so you can compare apples to apples. It's very handy. They also incorporated more domestic transport consideration within the international commercial terms, so that the rules can now be applied pretty much as written to intra-country transportation, not just international trade. They've been making evolutions in that space for the last 20 years, but the current version of the rules are the currently best suited for domestic transport, and they retain their same suitability for international transport. And they will include subtitles like for the use of domestic and international, blah, blah, blah. They also redefined the insurance coverage for CIP and CIF. CIF now has a minimum cover requirement unless otherwise agreed differently elsewhere in the contracts. Minimum cover is also Class C or free of particular average. And CIP is now a maximum cover default understanding unless agreed to elsewhere in the contracts, which is a Class A or all risk coverage. CIP for containerized cargo, CIF for waterway only break bulk cargo. They also brought better acknowledgement to the security requirements that have increased. In the wake of September 11th, 2001, security became a much more present focus for international trade considerations, and countries started adopting more and more practices for security-related concerns, including both on the import and the export side. And those understandings were incorporated in the 2010 rules a little bit, but then more aggressively in 2020 as those rules got more codified and put in place. They removed the DAT term and replaced it with DPU. It has the relatively same effective pattern, but DPU is a more descriptive name for delivered at place unloaded, which is similar to what delivered at terminal DAT meant in 2010, in the 2010 version, but DPU is a little more clear on what they intend. And the essential resources for understanding, comparing, and navigating all 11 terms are updated, and you can purchase many of those separately via the ICC website or access to the digital library to have access to them for printing for yourself or distribution within your organization. Okay, terminology is a big deal in the Incoterms, and understanding what they mean by using certain phrases can make or break the application of the Incoterms. First of all, and first and foremost, is the term delivery. Delivery within the context of the Incoterms, not within the context of your shipment. In the context of the Incoterms, delivery is defined as where the risk of loss or damage to the goods passes from the seller to the buyer. The seller obviously has the initial risk because they're the ones that have control of the goods. And at some point during the transportation chain, the risk is going to move from the seller to the buyer. And Incoterms helps identify where in that transaction that occurs. Again, this is not the same as delivery of the goods. Delivery within the Incoterms can be made at any point in the transportation chain. They define packing as complying with the terms of the sales contract as fit for transport. It doesn't include stowage within a container. It just means fit for transport. That's what they mean when they use the word packing. And then the pre-carriage, main carriage, and on-carriage are effectively the three phases of transportation. Pre-carriage being from the inland point of origin to that port of departure from the departing country or from that region. Main carriage being from that port of departure to that port of arrival. So ocean vessel transportation or air freight transportation from port to port. And then on carriage is the inland transportation from that port of arrival to the final point of destination. Hopefully that is very, very clear. Understanding these 5 definitions is critical to applying the Incoterms in your business. So why are these Incoterms important? Because it establishes a shared baseline for both parties, both the buyer and the seller. They supersede language barriers, and in fact, the Incoterms books and materials are translated into 27 languages. And this minimizes the risk of miscommunication, ensuring that both the buyer and the seller are effectively on the same page when it comes to roles and responsibilities. And that's what Incoterms really do. They clarify the roles and responsibilities for the buyer and the seller. They don't necessarily consider the roles for freight forwarders or customs agencies or brokers or anything like that. They're really focused on the relationship between the buyer and the seller. And lastly, as globalization increases, there is more and more opportunity for buying and selling across borders and between businesses of all sizes. We've seen a rapid growth in small sellers being able to access international markets, usually through other big box retailers or web-based retailers like Amazon and others. And many of these businesses have never heard of the Incoterms rules. So creating a shared baseline with your customers or with your suppliers helps ensure that you have successful transactions. It's important to use the rules correctly across all of your transactions, whether you're buying or selling, whatever role you happen to have, so that you can have the most effective and advantageous model. One of the other roles that Incoterms has is if you need to source your goods from an alternate supplier, either because of lack of inventory or because of excess duties that have been applied in recent years, Incoterms parity between suppliers helps you compare apples to apples. And lastly, as with all things in international business, communication is your most powerful tool. Use it to your advantage. Many times we recommend providing a translated Incoterms book or even sheets to your suppliers or to your customers so that they know what you're talking about in their own language. And it can be very, very helpful. Incoterms do not, this is one I get quite often, they do not address title transfer or revenue recognition. The transfer of the title of the goods is reserved for the contract, and that can happen at any point specified in the contract, regardless of which Incoterms rule is in effect. Incoterms are for the transfer of risk and responsibility, not for the transfer of title or ownership of the goods. Revenue recognition, similarly, is not within the scope of Incoterms rules. In the US, the point at which we recognize the revenue is an extremely important element of our tax filings and our business assets. And companies are very, very concerned with that revenue recognition point. Many companies will have title transfer or revenue recognition happen at the point of shipment. Some buyers will only accept transfer title when the goods have arrived at their plant. Knowing what those are is not within the Incoterms consideration. You need to address title transfer and revenue recognition and cost factors for the goods separately from the Incoterms rules. Incoterms rules do not address payment terms. You can apply whatever payment terms you want, net 30, net 60, fifth, third, Proximo, letter of credit, open account, site drafts. You can use any of these with any of the Incoterms because the Incoterms don't care about what your payment terms are or when you receive your money. They're always focused on the transportation chain between the buyer and the seller. And the Incoterms rules, lastly, do not create a legal effect all by themselves. You can create a legal effect by writing the rules into a contract or having them agreed upon elsewhere in writing, but they are not a regulatory factor. These are the international commercial terms, and they are not recognized formally by most governments. In fact, the US government does not recognize the Incoterms rules at all. When looking at the US regulations for exporting, Bureau of Census only considers whether the transaction is routed or non-routed. And that can apply to the Incoterms almost indiscriminately. There is no direct correlation between routed and non-routed and the Incoterms. So it's important to recognize that these do not have a regulatory basis. And simply adding the rules onto a commercial invoice is not a presumptive agreement, and it's usually not binding in the event of a dispute. The Incoterm being applied to the commercial invoice must be separately agreed to in a sales contract or purchasing contract. So if they don't do those things, what do they do? Well, Incoterms assign the costs. They determine who is supposed to arrange and pay for this element of the international transportation. They also assign that risk. The risk that we talked about in the usage of the word delivery, transit risk and risk of loss or damage accrues to either the buyer or the seller at some point in the transaction. And that responsibility changes hands between those two parties. The Incoterms will delegate responsibility and obligation, again, only to the buyer or the seller, not to other parties within that transaction. And they can create legal effect when referenced in a sales contract or a purchasing contract. And it's best to be explicit wherever possible. You can specify in the contract that you're going to be using CIP Buyer's Facility, Dusseldorf, Germany, Incoterms 2020. That is very descriptive and very clear on what the intended legal basis for the Incoterms are for these transactions. But it's not uncommon to have a sales contract cover multiple shipments of varying types. So you can be a little more vague and say that the contract is governed by the Incoterms 2020 and refer to the commercial invoice for the specific rule in effect for the shipment. And you can create those legal effect by including them in those contracts. And now I'm going to walk through the perspectives of buying and selling under the Incoterms 2020, what they look like in use, how to apply them, and how to review how they're being used. It's important to note that the Incoterms rules should be established during the contract negotiation phase. If that's not possible, then it's best to agree to them as far before the goods ship as possible. You want to minimize the amount of any confusion, and having them agreed to during negotiation is your best bet. Knowing how to use the Incoterm to your advantage based on your company's capabilities will put you in a position where you're able to secure an Incoterm that is most favorable to you. And that's really one of the key points for Incoterms is balancing those risks and responsibilities between the buyer and the seller and securing something that is advantageous to your transaction. Knowing what you can do and what you can't do is going to guide which Incoterms are going to be best for your organization. Companies with a very understaffed trade compliance and logistics departments are less likely to be in favor of transactions where they have more responsibility to perform. Similarly, companies that have a very robust infrastructure on logistics and trade compliance are going to want to use an Incoterm that provides them the most control over costs and transportation because they can affect change more effectively. In addition to using the Incoterms for the actual transportation, you can use the Incoterms language for quoting purposes. It's very, very common to request quotes from suppliers on an Ex Works basis, not intending to ship the goods under Ex Works, just to get an apples to apples comparison with other suppliers of those same materials. So you can actually use Incoterms for quoting purposes. And don't be afraid to request a quote on Ex Works, but then request shipment on a D term, a DAP or a DDP. Okay, so the rules in effect, I mentioned earlier that there are 11, and the ones that come into play for most shippers are the ones on the left, 1 through 7, for containerized cargo. Basically, if it can be put in a box or on a pallet or in a container, you want to be using one of the 7 on the left. The only time to use the sea and inland waterway only is if the goods are being conveyed from the point of origin to the point of destination using vessels only. Or if it's bulk and break bulk cargo, we have the ability to actually see the cargo itself on the ship or on the conveyance. Sea and inland waterway only terms can be used. But most people that ship in any sort of packaging are going to be using the any mode of transport rules: Ex Works, FCA, CPT, CIP, DAP, DPU, and DDP. Some examples of bulk and break bulk cargo would be like scrap metal loaded onto a barge or a ship, grains of corn dumped into a ship's hold, large machinery or equipment, wide load, things like that. Basically anything that doesn't fit into a container or special equipment is required. Those would generally qualify for the use of sea and inland waterway only. But effectively, if it goes into a truck or inside of a rail car container, and that's being part of the transportation chain, then you want to be using any mode of transportation. Applying the Incoterms. It's important, first of all, to know your role. Are you the buyer or the seller? Because that's going to dictate what you like and what you don't like about different Incoterms rules. And when I do Incoterms trainings for my clients, I will work separately with their purchasing teams versus their sales teams and make sure that they understand the perspectives that are most advantageous given what they are trying to achieve in that transaction. Know what your advantages are. How are you strong? Where are you weak? Do you have resident or non-resident importer advantages? Are you able to affect DDP shipments into a foreign country because you have a relationship with a resident importer in that country that can handle delivery to handle the actual import clearance and subsequently delivery to your customer? And also know the other party in the transaction. What can they do and what can't they do? If you're buying from a small mom and pop shop in Vietnam, they may not have the sophistication to handle the responsibilities of the transportation chain, and you have to pick those up for them. Similarly, if you're selling to a direct consumer living in a house in Germany, they're not going to have a whole lot of ability to affect the importation of the goods without going through a lot of hurdles. So know who your customers are, know who your suppliers are. I'm going to walk through the framing of these next several slides so that you understand what's popping up onto the screen. So bear with me. On the top left, there's going to be a color-coded progress chart that shows which Incoterm we're on. I'm going to give you the Incoterm acronym at the top, followed by the text of the Incoterm, as well as a destination or delivery statement relating to what the parameters of that Incoterm are. I'll give you an example of how the rule might appear on a commercial document, just as a reference point. And I'm going to give you a statement on the transfer of costs and risks between the seller and the buyer. Then we'll look at the buyer's perspective first, looking at the pros, the cons, and then my personal opinion on whether you should be using it or avoiding it generally. My recommendations would change depending on your specific circumstances, but I'm just trying to give you some sort of a guidepost that you can use. And then next, we'll look at the seller's perspective. Same thing, pros, cons, and my opinion. Okay, first up, we have Ex Works. Ex Works, and you name your place of delivery. The risk transfers when goods are made available to the buyer at the named place of delivery, and the buyer bears all costs for transportation. So the buyer has the most responsibility And the risk is transferring as soon as the goods are made ready for transport. So the buyer has the bulk of the responsibility here. So buyer controls the movement of the goods. That can be an advantage for the buyer because they have that full control. And there are no hidden costs that are in that price that you're paying to your seller. One of the cons can be controlling the entire movement of the goods, including all export formalities. Most foreign buyers, particularly buying from the US or when buying abroad, if you're a foreign buyer, it's very difficult for you to affect export from that country because you need to navigate their export rules and requirements. And this therefore accrues the greatest risk to the buyer. In most circumstances, as a buyer, I don't recommend using Ex Works for any reason for actual transportation of goods. I'm okay using Ex Works for pricing purposes, so you can do your apples to apples comparison for your goods, but I don't recommend using it for actual transportation. And notably, again, in the US, the export compliance formalities, the filing of the EEI, is the US PPI's responsibility one way or another. Whether it's a routed or non-routed transaction, they don't care whether you're using Ex Works or not. You've still got liability in that universe. Seller's perspective, Ex Works seems very, very easy on its face because there's no logistics effort and it provides the lowest risk to the seller. However, most buyers cannot sufficiently perform all export obligations, giving you limited customer opportunity and also accruing much of the regulatory risk that you have to have because of the regulations, even if it's not in line with what the Ex Works Incoterms states. So there's a misalignment in terms of who has which responsibility. And for that reason, I recommend that both the buyer and the seller avoid using Ex Works for actual transportation. Does it happen all the time? Yes, it does. Is it the end of the world? No, it's not the end of the world, but I recommend avoiding it wherever possible because there is a confusion over who has which responsibilities and risks. All right, FCA is the next one on the list. FCA stands for free carrier, and you would name your place of delivery. The risk and the cost transfer when either A, the seller places the goods on the buyer's conveyance at the seller's premises, or when the seller has delivered the goods to the buyer's named place of delivery. So you can have FCA being your factory. Basically, once the goods are loaded on that first conveyance, they are considered delivered under the Incoterms. Or you can have the goods brought to, for example, a port. And once the goods are brought to that named place, that named port, then the goods are considered delivered under the Incoterms. From the buyer's perspective, you get to control the movement of the cargo. Costs are transparent, and it is often preferred by many sellers. So it usually gives you a cost advantage on the actual price of the goods. But there is more logistics legwork involved because you actually have to get the goods shipped from that foreign country. Seller's perspective, again, minimal logistics effort. That's usually to our taste, particularly here in the US, but you have no control over the cargo, and it requires your buyer to be a little bit more sophisticated. That being said, I do recommend using FCA for most export transactions when you're the buyer or the seller. If you're the buyer, it gives you the advantages you want. If you're the seller, it gives you the advantages you want, typically. CPT, this is the first of the C terms. CPT stands for carriage paid to, and the risk transfers when the seller loads the goods on the first carrier. The seller is responsible for costs to the named place of destination. I used to like CPT a lot more for the buyer until I started to look into that risk transfer. The reason that CPT is good for the buyer is because it has good flexibility on that named place of destination. You can name a port or you can name an inland point, and the seller has to arrange for the cargo to be delivered to that point. But you retain little control over pre-carriage or main carriage logistics, and you incur the risk as soon as the goods are loaded on that first carrier. So even though the seller is arranging for the transportation to that named delivery point, you accrue the risk as soon as they get loaded onto that first container or first truck or whatever it is. So you basically have risk for parts of the transportation where you do not have control. Seller's perspective, you get to control the pre-carriage and main carriage without the risks. That's a very good position to be in for the seller because you can make sure that the transportation is happening correctly for your buyer. And if something goes wrong, you're not on the hook. And this is also usually very easy for buyers. Buyers don't have too much trouble arranging for transport from the port of delivery or just receiving the goods at their location. But the risk to the seller is that you need to ensure that the place that you're delivering to is a viable destination for you. If it's an inland point, you need to pay a little bit more attention to how you're going to get the goods off the boat when they get delivered at the port and from that port to the final place of delivery. However, I do recommend using CPT if you're the seller because it gives you that control without the risk. And you can see how the perspectives matter when you're the buyer or the seller. CIP, very, very similar to CPT, but this is the only Incoterm in which the insurance is explicitly considered within the context of the Incoterms rule. CIP stands for carriage and insurance paid to a named place of destination. Risk transfers in the same place when the seller loads the goods on that first carrier. And the seller is responsible for costs to the named place of destination as well as the insurance. Again, this is the only Incoterm rule that considers insurance. It is not considered for the D terms. From the buyer's perspective, benefits are good flexibility in the named place of destination, and insurance is explicitly covered by the seller. So those are some good advantages. And the downside is you have minimal control over pre-carriage and main carriage logistics, and you retain the risk of loss or damage in transit. For that reason, again, you're accepting a risk for a part of the transportation where you don't have control, which makes it problematic if something goes wrong. So for that reason, I would recommend avoiding it, generally speaking. Sellers, similar to CPT here, you get to control all the pre-carriage and main carriage without having any of the risks, and it makes it very easy for your buyers. Again, the same risk of ensuring the named place is viable, and securing cargo insurance as directed by the buyer can be problematic depending on what parameters they give you or what demands they have on you, although a lot of that risk can be mitigated by having a global cargo insurance policy. Okay, now we're into the D terms. There are 3 D terms, and DAP being the first one, which stands for delivered at place. And you would name your place of destination. In this event, risk transfers when the goods are available for unloading at the named place of destination. So when they're made available for unloading. And that's a key contrast with the next term that we'll look at. The seller bears the cost for delivery to that named place of destination. From a buyer's perspective, there's minimal logistics. Basically, you have to receive the goods when they arrive at whatever place you name. And this is typically the first term that is considered delivered pricing. An argument can be made that the C terms are delivered pricing, but generally they're not viewed that way. The downside as a buyer is that the costs can be opaque. You're not always certain if you're getting the best deal on the goods when you're buying under DAP terms, because there are other steps included in your buy price that may not be transparent to you. Freight costs, insurance costs, other hidden costs, processing costs, brokerage fees, forwarder fees, all those things usually get rolled into the cost of the goods, and it's difficult for you to control your costs that way. Seller's perspective, this is often preferred by many buyers. So this does make it advantageous because buyers love to just get the goods. I do recommend being cautious with DAP when you're the seller, particularly with inland transportation to certain destinations that may require unforeseen delivery quirks. There's horror stories out there of delivering to a place in India where the only way to access the delivery point was via goat up the mountainside. And if you're the seller and you're responsible for getting the goods up that mountainside, you have a hard time arranging for that transportation. So just be aware. It's not necessarily an avoid in all cases, but you want to pay attention to what that delivery point is and know if you can actually achieve it. But typically you would want to lobby in favor of a C term when you're the seller, because that provides you basically the same sort of benefits to the seller while having less risk for yourself. The next D term is delivered at place unloaded. The risk transfers here when the delivery occurs at the named place of destination and the goods are unloaded. This is what's different from the DAP term. DAP does not consider the unloading of the goods as part of the scope, whereas DPU does. This is more of an edge case sort of situation when you have special cargo that requires care and handling from the seller for that unloading step. You want to ensure that it's being unloaded properly. This can go for things like large equipment or electronics, things like that, that have particular care requirements. The seller bears the cost for delivering and unloading at the named place of destination. Minimal logistics from the buyer's perspective. Unloading may be a particular concern for your cargo, so that makes DPU more advantageous. Again, mostly opaque costs, and not all sellers can perform. However, it's a good one to use if it is appropriate for your goods. Just be careful of using it generally. It's not a general use term. It's a when the goods require it. Otherwise, use DAP. From the seller's perspective, not a whole lot of pros to deliver at place unloaded. Really, the risk here is unloading at the foreign destination may be problematic. Again, reaching that foreign destination and then having the unloading parameters built into the performance of that delivery can be very, very tricky. And the last term here is delivered duty paid, DDP. Under DDP, again, you're naming the place of destination, and the risk transfers when delivery occurs at the named place of destination, same as DAP and DPU, but now we're including the words free and clear. Free and clear means that they have been cleared customs and are free for use within the commerce of that foreign country. So the seller is bearing all costs and customs responsibilities through to delivery at the named place of destination. As the buyer, this is the lowest amount of effort you can possibly put in to get your goods. So no logistics efforts, low risk. You have none of the import formality risk. The only downside is that the costs are all opaque and there are more costs in DDP than there were under DAP or DPU. And the other big risk to using DDP when you're buying is that not all sellers can do it. Not all businesses can ship to the US on a DDP term and actually affect entry into the US. The US has a non-resident importer program where foreign businesses can register to be an importer of record in the US, but it's not very common for a lot of foreign businesses to do that. And similarly, if you're buying under DDP, you put a lot of responsibility onto your seller to do a lot of work. Again, looks great on paper, but when you actually get down to brass tacks, whether or not they can do it becomes a major hurdle. I mentioned earlier that you can buy the Incoterms books from the International Chamber of Commerce, and they will ship them to you DDP. They handle customs clearance into the US for these goods, and you receive them free and clear. From the seller's perspective, DDP is often preferred by many buyers, and you will often have to field requests for DDP. And it is the lowest barrier to landing customers. If you can deliver DDP to various destinations, it is a great way to make it look great to your customers. All you have to do is pay me, and I'll bring the goods directly to you, free and clear, and they're yours to use. That sounds pretty good if I'm the buyer. However, you're taking on the import clearance responsibilities when you're the seller. Duties, taxes, fees, any other costs required to land the goods in the foreign country, hidden or known, you will have all of the risks and all the costs on your shoulders until the goods are delivered free and clear. It requires the greatest effort and substantial infrastructure to support, and it provides the most risk to the seller. And as a seller, I would recommend avoiding DDP unless you've got all of these boxes checked and you're willing to accept those responsibilities and those risks. Recap. Buyer preferred generally, again, this is my just blanket statements in general. For your business, the answers would probably be different. But generally, I say buyers should prefer DDP, DAP, or FCA, and the sellers should prefer CIP, CPT, or FCA. Does that make FCA the best universal term? No, not necessarily. But there are benefits to both of those for both the buyer and the seller. Considerations, you generally only want to use XWorks for quoting. I recommend this to everyone that's looking at XWorks as an option for their shipments, whether buying or selling. If you're buying, get an XWorks price from various suppliers and then layer in the freight, transportation, and customs clearance costs separately so that you can compare the apples to apples on the goods and on the freight and other parameters. Incoterms rules may have explicit or implicit consideration for trade compliance factors, so it's important to know your role. Is there other export filing requirements? Are there customs clearance requirements? Are licenses required? All of those need to be recognized by both the buyer and the seller prior to agreeing on a rule. And this goes back to what I said earlier. Communication is extremely important. If you're the buyer and you're buying DDP, what responsibilities do you have to inform your seller of what the import rules are? It can depend. If you're not communicating with your seller overseas, then their ability to actually bring the goods to you under DDP is likely in jeopardy. And then the goods get held in customs and you never get your cargo. Similarly, if you're buying on XWorks, you need your vendor to tell you what the export clearance requirements are if you're going to be able to perform those. It's not that you cannot use those Incoterms, but you need to understand what your responsibilities are, and it requires communication between the buyer and the seller, as well as their transportation partners in many cases. So what about the sea and inland waterway rules? Why didn't I talk about those? It's because, in my experience, most companies should not be using them. So I don't give them their full due on these presentations, because unless you're shipping bulk or break bulk cargo or special equipment required shipments, you don't want to be using the sea and inland waterway rules. But the rules here, for sake of being complete, are FAS, which is free alongside, and FOB, which is free on board. You would contrast these against the free carrier, the FCA rule for the other set. And importantly, do not confuse FOB with the Uniform Commercial Code, the UCC usage of FOB. The UCC is a United States set of regulations handling interstate commerce, and the FOB term is used liberally within there. There's at least 4 different types of FOB within the UCC. Those are not Incoterms rules, and they don't have any correlation to the Incoterms rules that we're talking about today, but they use the same letters. And it's very confusing for a lot of companies because most US businesses will sell or ship under some version of FOB domestically. But when you bring other countries into the mix, they don't follow our Uniform Commercial Code. They don't know what our rules and laws are, and those rules and laws have no effect on that international piece of the transportation. CFR and CIF. CFR stands for cost and freight. CIF is cost, insurance, and freight. And these are direct correlations to CPT and CIP, just for sea and inland waterway only types of considerations. And importantly, all of these end with a named port of shipment. They do not end in a named place of delivery. Selecting the right rule for you is based on awareness. You want to recognize your capabilities as well as those of the other parties to the transactions. Who's got access to better transportation pricing or services? If the goods can get there faster or cheaper, whether you're normally buying on FCA, but if your seller has the ability to get them to you faster or cheaper than you would normally, then buy on a D term, buy on DAP. Similarly, if you're selling overseas and your customer has the ability to move the goods faster or cheaper, then let them buy on an FCA term or an Ex Works term even, and don't try and sell on a C term. Recognize those capabilities. Make sure that you understand what your interest is in the transaction. Are you angling for the best price when you're buying? Are you angling for the best service, the best balance of the two, the least amount of work, maybe the most control, maybe the minimization of risk? All of these are very important factors that are unique to your business and have to be weighed in order to understand why you're going to be choosing which Incoterm you are in each circumstance. Your company may have a blanket policy of always selling on an FCA term and always buying on a DAP term, but circumstances are going to arise where you want to deviate from that standard practice, and knowing why you're doing it is important. And you want to lastly acknowledge the other party's primary goals, responsibilities, and capabilities. Smart, savvy buyers and sellers are going to be able to recognize what the buyer wants or what the vendor wants and be able to fold those considerations into that negotiation phase. Your goods are on a ship passing through the Suez Canal and the boat gets stuck. Oh God. And they get stuck for a matter of weeks. And there is a force majeure or a general average called on the shipment. So who has the risk for the loss or damage of the cargo on that boat? And the answer is that it varies based on which Incoterm rule is in effect. The buyer has it on Ex Works, FCA, CPT, and CIP, and the seller has that risk under DAP, DPU, and DDP. So it's important to recognize in a real world scenario where you have a boat getting stuck in the Suez Canal for a matter of weeks and general average being called, who's going to have to bear the burden of that loss? And there you have it. Heading into the last section here, key takeaways, tips and traps. Buyers, I recommend that you always get quotes on an Ex Works basis, but avoid buying on Ex Works. I've said it a couple times, but you want to compare those apples to apples on price first, then decide your logistics. And you want the option of supply chain versatility, and Incoterms rules are one of those key steps, particularly in the case of the advanced tariffs on sections 232 and 301, as well as the AD/CVD cases and the customs enforcement generally, as well as Uyghur Forced Labor Protection Act, UFLPA, and imports from the ex-UAR region. Those risks get folded into your considerations when buying from overseas and recognizing what the possibilities are. So buying on an E or an F term from certain locations can be problematic. Sellers, smart, savvy international sales teams can help break through market barriers. If you've got a sales team that knows how to work with the buyer to identify a mutually beneficial Incoterms rule, then you're going to be in a better position versus your competition, or just a better position to break into that market and get your goods established in that region. I recommend purchasing foreign language copies of the Incoterm resources to help you communicate with your buyers. If you're typically going to Spanish language regions, buy several Spanish language translations of the Incoterms rules book from the ICC and send them to your customers. It can really make a big advantage. Incoterms rules are a negotiating tool. And for all negotiations, you want to know what your advantage is, what your structures are, and make sure that it's advantageous for all parties. You want to modify the rules to fit your intentions. There's no reason why you can't have a DDP rule that excludes taxes. DDP normally implies that the taxes for the import are considered within the scope of the Incoterms rule. You can say, I'll do GDP, including customs clearance, but I'm not paying any taxes. Those are for your account. And you can structure your Incoterms rules around that parameter. You can have FCA, including insurance. So CIP is the only Incoterm that is considering insurance, but you can explicitly state that, hey, I want to buy FCA, but I need you to cover the insurance. And you can write that into your contracts. Just be clear and make sure everybody agrees. Global cargo insurance policies are often cost advantageous if you have any steady international volume. I do recommend working with your insurance providers, or if you want some recommendations from me, I know some in the Cleveland area that would be able to write some policies, and this can give you warehouse to warehouse insurance coverage on all of your shipments at a relatively inexpensive price compared to purchasing it on a spot basis for individual shipments. And then again, by the foreign language Incoterms. Non-dutiable charges. This is one of the questions that was submitted beforehand. For US buyers, many transportation charges may be non-dutiable. Typically, we're talking about the main carriage and the on-carriage costs that should be excluded from the entered value so that you do not pay duty on those transportation costs. Pre-carriage costs are usually counted as part of your dutiable charges, but the main and on-carriage costs are usually considered non-dutiable. But many times when you're buying on a delivered term, and here we're talking about C or D terms, those transportation costs to that final point of delivery are often rolled into the price of the goods. So when you import them, you're importing based on the invoice value, and there could be freight costs hidden in that invoice value that you're paying duty on that you shouldn't be. When you factor in Section 301 duties, an additional 25%, that can be a significant amount. So you want to make sure that you are able to remove those non-dutiable charges by having the right documentation on hand. You may not arbitrarily downvalue your goods based on estimates. You can't just use, well, freight prices are generally $2,000, particularly lately where freight prices are insane. You must have usually a rated bill of lading from a steamship line or the NVO that's handling the carriage of the goods. And you need to notify your broker that's handling the importation what the correct customs value is to report and provide them with that documentation to justify it. Typically, FCA transactions are best suited for avoiding unnecessary duties on transport costs. So if you buy on an F basis, then the main carriage and the on carriage, you're usually paying for separately from the cost of the goods, so you don't need to worry about it. Landed cost is a way for determining all the cost factors required to get cargo from one point to another. Not all countries apply duties, fees, or taxes the same way we do in the US. In fact, we are relatively unique. In most cases, we charge duties on the FOB basis. Again, not the same FOB that we're talking about, either with the Uniform Commercial Code nor with the Incoterms rules, different FOB basis. US and Canada, I think, are the only two that use that basis. And the US has no tax on imports. Other countries have VAT, and it's usually charged. Duties and taxes and other customs fees are attached on a cumulative basis. So knowing what your landed cost is going to be to get the goods in the hands of your customers or to get the goods into your hands from abroad, you can use a landed cost analysis to get there. And we can do that if you're interested. Freight costs are a big deal. I usually recommend for anyone with substantial volumes or repeat volumes to look into joining a shippers association, allow you to evaluate alternate lanes, adjust transit time requirements, and other options to help you maintain your competitive advantage. Particularly helpful when freight costs are insane. If you can get hooked up with a shippers association, it can be very advantageous. We work with one primarily out of Columbus, Ohio, and we use the iRate rate management system for comparing those freight rates. And that can be a very helpful tool on those costs front. And then the last thing I have before we get to questions is we do provide tailored Incoterms rules training for your organization with your teams. We have multiple sessions and we work to understand what your business requirements are, what your customer base is, what your production practices are, so we can provide tailored recommendations and how to use them in practice. Feel free to send follow-up questions or your NCBFAA credit request to train@starusa.org. There is one credit available.